Yeah, hello everyone. Good morning. You're welcome to our webinar. Today's class is going to be very interesting. As usual, all our classes are interesting. So if you can hear me, kindly just put up your, or I don't know if you can raise up your hand or you can show a signal that you can hear me. Am I audible? You could type on the chat group, yes, or you could type, if you can't hear me, then obviously you can't type. If you can hear me, kindly type yes on your chat window. Okay, beautiful. Tams can hear me, hand raised up. Okay, so we're going to be beginning. Today, we're going to be looking into steps towards trading success. Now, today's class is awesome because, you know, I was talking with someone on the phone just now before we resume this class. And one of the things he was talking about was who mentors you would actually determine how far, or rather how quick you get to success when it comes to trading. As in anything, even if it's physical work like construction, if you learn from the wrong people, obviously your construction process will be always wrong. Now, when it comes to trading, it's no different. There is a how to succeeding in trading. I keep telling people trading is like math. You know, there's a formula for success around trading. You just need to apply the right formulas. So we've all heard about almighty formula and solving quadratic equations. You know, bring whatever quadratic questions or problems with the almighty formula, you can dismember it and solve it. It's the same thing when it comes to trading, and I want us to pick a couple of points as we go in. And these points are not just things that are head knowledge, just written down from textbooks. These are points that have been gotten through years of experience, years of studying the markets, and hard knocks, you know, left, right, center, just to get these results, you know, for ourselves, and then in process also share with other people. So I'm going to be going in and we'll be digging a lot of points from there. So hold on, I want to share my screen with you. Just kindly give me a second. Okay, I guess you guys can see my screen, right? If you can see my screen, kindly raise your hand, or you can chat me up. Can we see my screen? I'll need feedback, so I would know we're on the same page before we proceed. Okay, thank you. Okay, I see that we can see my screen. Okay, before I go further, I'll just introduce myself. My name is Ikena Okafo. I'm the country manager for Anzo Capital. And I've been trading actively for about 16 years. So I didn't start trading today. And from my years of experience, I've learned a lot of things that don't work and a lot of things that works. And I will classify myself as a very successful trader, not someone that is in and out of the market, no results, nope. But as a very successful trader. And I also want to share with you those little tips that have made me come out of, I'll put it, proverbial hole that people keep digging. Okay, so let's start with the slides. Let's go in. Okay. Now we're going to be talking about 12 steps of trading success. So as I go on, I want you to pen these points down. Remember, the shortest pencil is always longer than the longest memory. Whatever you see or whatever you hear, please have a jotter to put things down. Never trust your memory to remind you of everything. Always refer to what is written down somewhere. Okay, so we're going into the first point. And if you have any question, feel free to get my attention. You can put up a new chat, or you could enable your mic. If your background is devoid of noise, enable your mic and just ask the question. You know, I'll be happy to respond to you. Okay, so our first point would be this: understanding the potential of the global financial markets. Now, I really want to underscore this, because in everything we do in life, the reason why is the most important reason, you know, for going into anything. If we can't give ourselves a reason why, there really is no motivation to proceed. Now, you see, when it comes to the financial markets, do you know that when it comes to, well, when we look at industries globally, what industry is responsible for the most billionaires and is the most lucrative industry in the world? Now, let me ask that question, and I want us to respond. Please, what industry is responsible for the most billionaires, or rather, is the most lucrative industry globally? Is it the pharmaceuticals industry? Is it the manufacturing industry? Is it the IT industry? Let me have feedback. Anybody? Today's class ought to be interactive. It's not a one-way discussion. It's a conversation. Okay, I need response. What industry do you view as the most lucrative industry currently? Okay. Okay, someone says the IT industry, another person says the financial sector. Okay, is that all we have as feedback? Okay, so currently, the most lucrative industry is actually the financial industry. Is more lucrative than even the IT industry. And you know, manufacturing even comes in second. The manufacturing industry is more lucrative than the IT industry. You know, the IT industry comes in third. Okay, so says Forex and cryptocurrency. Okay, well, it's just a subset within the financial industry. Okay, so I'll tell you, number one is that you're in the most lucrative industry ever known to humankind, the financial industry. And then we have subsets, you know, subsets within that industry that accounts for lots of wealth created or wealth transferred. And working, so for city markets, for those that don't know, understand CFS, so I'll give you an example. Now, when it comes to trading on any financial instrument, there are three ways we can participate in the financial, or rather in transactions. Now, number one is, assume we're trying to buy or trade gold, okay, or participate in the gold market and participate in its price changes, right? One way is you could get gold off the spot market. Now, buying on the market means that you've gone to a gold dealer and you're buying gold off the spot market, and you're taking the delivery of the physical gold. That's one way to participate in gold trade. The second way is through buying gold on the futures markets. The futures market, another way to transact on the value of gold is through CFD trading. So through a broker like Anzo Capital that is registered, regulated, Hello, can we hear me now? Okay.
Yes, your screen is off. Your screen is off. The shared screen.
Okay, I'll share the screen back again with you. Okay, so I've moved my internet connection to a different network. Let me be sure that there is no fluctuation. So I'll share my screen back with you again. Okay, so like I said, the financial markets basically are the largest ones, and I was talking about different types of different ways of getting into markets. The first one I talked about was the spot trading. Second was through the futures market, and the third was CFD trading. And I was trying to explain what CFDs were. CFDs are simply a contract. It's simply a contract. So you're buying gold, you're buying a contract for gold, and what you're trying to do is you're trying to transact on the difference in price of gold. So I'm getting into a trade today. The contract states that I will get the difference of the value of gold when I get out of the contract. So if I get into gold today at 1,005, and tomorrow I get out and I close the trade, for at 1,008, price reads 1,008 per dollar, right? I will get the difference, which is a profit of 500 or the 1,005 all the way to 1,008. That's what I'll take out of the market. Now, if I get into the market at 1,008 and price recedes down to 1,006, I will take the loss, which is the difference. So it's simply a contract. It's about the cheapest way to get into transactions like this. And one of the reasons why CFDs are very lucrative or rather useful, is because of leverage. So on a different class, we'll talk about these things. So number one is, I want you to understand that the markets you're in are the largest markets known to man. And then the Forex market in particular has, so for now, it transacts over 6 trillion in every day that passes, dollars exchanging hands. Okay, and then when we look at the stock markets has a lot of volume though, but picking out one stock exchange, for instance, the New York Stock Exchange, we have about $22.4 billion exchanging hands just in the New York Stock Exchange alone. That's a lot of money in one day. You look at Tokyo, that's about 18.9, London about 7.2, and then we have other stock exchanges globally, Frankfurt, Stockholm, even Ghana, Nigeria. So you could add all the stock exchanges, the total gross volume daily together, it would not equal 10% of the Forex market. So there's a lot of volume in the Forex market. So a lot of people want to use the Forex markets to achieve their financial goals. So one, the potential of the markets are massive. Now let's go to the second step. You know what? I'm going to ask a question and I want us to respond. Now, imagine if someone came into this webinar and so what we just saw on his name tag was let's use Dangote. So he comes in and he throws a challenge, and he says, I'm going to offer every single person here an option to choose. Now, I have 5 G-Wagons just in front of my office. So 5 G-Wagons in front of my office, and in each G-Wagon I have 200 million, or let's use 100 million naira each. So he's offering you 5 G-Wagons with 100 million naira each in those G-Wagons, as against now he holds on his other hands. So we're watching him via video. I have 10 naira, 10 Nigerian naira. Okay, and that naira will make 100%. It will make 100% of itself every day, but for only 31 days, just 1 month. At the end of the 31st day, you will take the final value of its growth. Okay, so day 1 it's 10 naira, day 2 it's 20 naira, day 3 it's just 40 naira. Now, the question is, within 10 seconds, what would you choose? Would you choose the G-Wagons? Now, mind you, the G-Wagons, basically, each one around 50 million. So 50 million times 5, that's 250 plus 500 million in the boots, right? That's 750 million naira. Now, what would be your choice? Would it be the car keys on his hand, the left hand, or the 10 naira that will have 100% every day just for 31 days? What would be your choice? And I want to see responses. Okay, oh yeah, let's start responding. What will be your choice? the car, 5 car keys, G-Wagon keys, total value 750 million naira, or the 10 naira that makes 100% daily. I want to see a response.
Five wagons and 10M, that makes 10% daily.
Oh, you choose the 10 naira, right?
No. Sorry, I had a call
interrupted
me. So you said 5 wagons or what? 10 naira.
Okay, I'm not hearing you. Okay.
No, I said I'm sorry because I would have responded. You said 5 wagons or what that makes 100% daily?
The 5 G wagons with a total of 500 million within, or 10 naira that makes only 100% daily. You know, for the total value will be received on the 31st day. What will you choose?
Okay. Thank you.
Okay, can we type it in if you are not too sure or you're not confident to talk? Just type it in. I want to see a response before I move on. Okay, so where is everyone? I can see names everywhere here, but I'm not seeing responses. Okay, beautiful. Adam says 10%, 10 naira, right? That makes 100% daily. Okay, I can see another one, 10 with 100%. Okay, beautiful. So it looks like some people are taking expo. But you see, I know a couple of us will be willing to take the G-Wagons, that's the 10 of them, that has a total value of 750 million naira. But this underscores my second point. Now, Einstein calls it the 8th wonder of the world. He who understands it will earn it, and he who doesn't will pay it. And it's basically understanding the secret of compounding. You see, the magic that goes on in the financial market, that linchpin that most companies, pension funds, asset managers all go after is compounding. You see, this changes every single thing when it comes to making money in the financial markets. I'll give you an example. So let's look at this example. Now, imagine that 10 naira we talked about, right? Just check it out. The first day it makes 100%, it becomes 20 naira. For the second day, the capital, grows to 40 naira. Now, after 15 days, what we have is 163,000 naira, roughly. Now, this doesn't seem like much in comparison to 700 million. Now, to the next 31 days, what we are having on the 31st day is 10.7 billion naira. It's amazing when you see these kind of results. This just goes to show you what compounding does. I'll give you an example. Do you know that with 1 million naira, and you pursuing 6% daily, just 6%, at the end of 1 year, you would have made 100%. Now, 6% times 12 is not 100, it's just 72, right? But compounding, it will be 100%. You can do your math, you find out I'm right. Now, if you do that for 10 years, you don't touch the 1 million. So after the first year, it becomes 2 million. After the second year, it becomes 4 million. After the third year, it becomes 8 million. Now, you don't touch it, and every other year you do 100%. Mind you, to do 100% yearly is very, very straightforward. You can do it in financial markets. Some people are going for 500%. Some people are going for 300%. Some people are going for 40%. It all depends on your ability and your willingness to raise the risk level. Okay, now, at the end of 10 years, you find out that your 1 million is no longer 1 million, but now, who could guess? Let me just tell you, 1.4 billion naira. 10 years. 1 million becomes 1.4 billion naira. You see, the profits you make in the financial markets are not the one-off trades that you place a trade and then you say, oh, I made, so you have $1,000. I made $1,000 profit, or I made $500 off the trade profit. If you're doing that, you're going to kill your account very soon. Or you have $10,000, you say, oh, I made $20,000 at the end of the trade or at the end of the month. That is a recipe for failure. Success in the markets comes with little profits that come together, little. So you have $10,000 in the markets, and what you made at the end of the day trading, $200, $300, $50. But what happens to these results? They do what? Compound. That's the secret recipe that makes your account grow massively. I'll give an example. Someone that has an account of $5,000 that pursues 30% monthly. Now, pursuing 30% monthly is doable, but I'll tell you, if you have it as a target, it is not a must that you hit your 30% monthly. A month can come and you might fall down to 7% as your in return for the month. Another month can come and you could find yourself at -7%. It doesn't change anything. Another month will come where the markets respond so favorably to your trading style, and then you make 60%. But let's say averagely you hit 30% monthly. Now, do you know that at the end of the month, your 5K will bring a profit of $1,500? I wish I could inscribe, right on the screen. I could do that. Yeah, good. Okay, I think I have the right pen for that. So let's do that. Let me show you something. I'm going to annotate on my screen. So permit me to do that somewhere here. So okay, good. Your 1K, okay, your 5K will bring a profit of 1,500, right? 1,500. Okay. Now, every other month, assuming that we have one person consumes the whole 1,500 every other month, you find out that at the end of the year, what you made at the end of 12 months, okay, so at the end of, so it's tough to write with what I'm using. Okay, let me see. Let me see. Okay, so just ignore what I wrote there. Let me try and write it again. Okay, so at the end of 12 months, what you have from this transaction is $5,000 startup capital, and total profit is $18,000. Now, because you've been making 30% every month, you have grown your equity to $23,000. Now, you've done very well for yourself. This is great return. Everybody will be looking for you to trade for them. But now, there's another school of thought where you delay your gratification and allow your funds to compound. When I trade, I do not look at withdrawing anything from trading account unless 6 months has elapsed, or preferably for me, it's 1 year. I don't touch it for 1 year. If you are so much in need of your capital to eat or to make transactions, please do not put it in Forex markets. You need your money to grow before you make withdrawals. So I'll show you this. Now, I start with $5,000, and then I allow the $5,000 to compound. Now, after 12 months, I'm going to have on the next January around 120. I don't know what it was, but it's $126,000. So my $5,000 is going to grow, is going to exponentially compound to $126,000. Now, compare the two people. This guy was chewing the whole thing up every month, the profit. This other guy delayed the gratification. And you see the results, 23,000 as against 126,000. Do your math. You find out that what I'm writing is correct. There's a world of difference. So you see, the key to succeeding in trading is compounding. Even if you're doing 6% or 5% or 10% monthly, let it compound. The final result will amaze you. It's a world of difference between arithmetic progression and geometric progression. So that's the second point. Let's move to the next point. So if you have any question, feel free, type it in the chat window or enable your mic and let me know. Okay, so the next point simply is learning to determine and manage risks. Now, I'm going to share with you guys these things I'm sharing. I never knew about these things. I felt trading was, you come open an account and then you place trades, and then you make money, and then you withdraw the money, and then it was all a race to grow your accounts, or make big profit and then withdraw To me, what I was doing was gambling. I didn't know that it was gambling. You know, I wasn't trading. I wasn't following those principles. Now, another thing I learned was, and this is one of the reasons why I was able to stay in the market, even when I was not successful at the time. It was simply learning to determine what the risk would be each time I got into the markets. Now, if you get into a trade and you do not use a stop loss, now for those that don't know what stop losses are, it's simply a price level of which you're saying, if the market, so I get into a trade, if the market goes against me, so if I'm buying and the market goes downwards, at that particular price level, I assume that my idea about that trade was wrong. If you don't have that point in the market where your trade idea is wrong and you want to come out of the market with that little loss, I'll tell you, what you're doing is gambling. For those that do not use stop losses, you are not trading. It's like, imagine what you're doing is you're getting into a car, you checked, oh, it has an accelerator and it works, and you start revving, and you're revving, but you never ever bother to install brakes. You will move, you will make progress, no doubt, but not one day, at a particular point in time, you will need to apply brakes, but the obstacle is just in front of you. So imagine hitting the obstacle at probably 150 kilometers per hour. It will be not just an accident, to be something else. So that's what most people do. They set their accounts to run and they're making profits. They have no stop losses. They don't want to experience slowdowns. They just want to see profits coming in. But one day the market will decide to go in one way, just like what happened when Russia sent the first missiles to Ukraine. What happened that day was people saw the market dip in ways, for certain instruments, in ways they never imagined. For gold, for a couple of other instruments, it shot up. For oil, it was rallying massively. So for those that were taking the counter position, and had open positions with no stop losses, I know of a good number of them that were wiped out. So these are the things you want to avoid. When it comes to trading, you must determine what the risk is per trade. And in determining it, you must know what percentage you're getting into the market with. Now, what I'm telling people here is use 1% of your capital to trade per trade. If you're more adventurous and you're more comfortable or confident about your trading style, you can go into 2%. But please do not go above 2% of your account on any trade. Unless your trading style, like I've come across one, so one of those trading styles we taught, it doesn't give you as many options to enter. And it was the success rate for the trading style was high. That's where you could assume 4% risk per trade. But beyond that, please, for this class, do not go beyond 2% risk per trade. Now, I'll give you my reasons why. Now, something I wanted to annotate on the screen. I can't remember what it is, but let's just go on. Now, imagine you started with $2,000 and you're in the market. 1% of $2,000. Okay, now just remember, some people might not understand, okay, how do you capture 1% of your account on a trade? And I think I need to share this because not everybody knows how to do this, and I want to teach it. Don't worry, we're going to record this and we'll share it you could watch this video, this webinar afterwards. Okay, so I'll show you what to do. Now, to capture 1% of your account, so look at the right side of your screen, on the left side, of your screen. Imagine you're getting into the market with $5,000, right? $5,000. Let's change this to red. Okay, so you're getting into the market with $5,000. Now, we need to know what 1% of $5,000 is. 1% of $5,000 is simply $50. So you find out what 1% is, it is $50, right? Now, when you get into a trade, there's the entry price and there should be a stop loss price where at that point, your trading idea was wrong and you should have that point. Okay, so let's assume from your entry price to your stop loss price, in between it is 50 pips, or let's use a different number. Let's say 40 pips. Okay, for ease of calculation, let's use 50 pips, right? Okay, now your dollar amount, which is 1%, so that's 1%. Oh, so I'm writing a fraction. Okay, so that's 1%. Don't mind the way I'm writing. It's not so easy to write on my screen. Okay, so you have 1%, right? That's $50. So it's going to be $50, right, divided by number of pips. And so in this case, is 50 pips. So you're trying to find out how much you're risking per pip. And in this case, you're risking $1 per pip. That's what you're risking in this case. Now, you need to find out the lot size that will capture for the particular instrument you're trading that will capture $1 per pip, such that if it goes against you 50 pips, you'll be losing a maximum of $50, and then the market will, or the broker will cut you out at that loss, right? You know, so you don't lose more than $50, which is equivalent to 1% of your account. Now, to find out what lot size, so it depends on the instrument you're trading. So you could check under our website. You have tools and resources. That's from the homepage, and then you could look for. I'm trying to remember what it is. PIP calculation value. So, but if you check through there, you will see it. What we're looking for is the PIP price value of the instrument, but roughly, you could just divide it. But if you find out what's the PIP price value, maybe Euro JPY might be 13 point something, you can just put it as 13 instead of 10. But roughly, GBP USD, Euro USD are 10, or rather is 10. So you divide it by 10, it will give you 0.1 lots. So you're getting into the market with 0.1 lots. And for GBP USD, 0.1 lots is equivalent to $10 per pip. Sorry, $1 per pip, I mean. 0.1 lot is $1 per pip. And that's still equivalent to this. This is your $1 per pip. So you've gotten into the market with the right lot size. You have your stop loss price at the right place. And so if the market goes against you 50 pips, you will lose only 1%. That is how to capture 1% of your account on a trade. Okay, so going down. Now, looking at this example, let's assume, now this is virtually, let me use the word virtually impossible to lose 15 times. But let's assume that, for example's sake, we wanted to lose 15 times using 1% of our account to get into the market. The first loss we will make is $20, which is 1% of $2,000. Now, if I lose $20, will I die? No, I'm very much still in the trade. Now, assuming we lose 15 times. Now, I know for some people that got into the markets, you know, thinking it was a slot machine, just 5 trades is enough to finish the $2,000. They've wasted the whole $2,000, and the account reduces to maybe $20. You see, but obeying this rule, not risking more than 1%, even after 15 trades, your equity is $1,720. Do you put it into your calculator and find the ratio of it to the initial startup capital? You find out that you still have around 84% of your equity remaining. So the question is, let me even ask you guys, are you not still in business if you still have 84% of your equity remaining? You're very much in business, right? Now,
yes.
Feel free to respond on the chat. Yeah, good. You're very much in business. You have a lot of money to still play with. The thing about trading, you need to fashion your account such that it gives you longevity in the market. I keep telling people there's no way under heaven and on this earth I can blow my account. It is not possible. Not possible. Now, mind you, this information is coming from a broker. So you wonder why is it that the broker has your interest at mind? Because we're a non-dealing desk. We want people to trade successfully. If you have money trading, our revenue stream is simply rebates. We want people to trade and make consistent income, grow what they have, so that their account balances. It's just like saying, would you want the bank to have all of its clients duped and then they have no deposits? No bank is praying for that, you know. But because we operate the same model, since we earn via rebates, we want people to stay in the markets longer. So that's what I'm telling you guys: reduce your risk per trade. Don't be tempted to go into the market with 5% or without a stop loss. Don't do that. So even if you make mistakes, your mistakes are small. And it's easy to correct it. And I'll show you how you can correct it easily. Okay, let's go to the next point. Now, this is, I'm sharing, these points. Now, when I started trading, I didn't know what I was doing. I'm trying to draw somewhere, okay. If this was my capital, and then this was time, this is what I was doing. I would start grow up, wow, grow, wow, because I was not doing the right things. When I understood this rule, it was, if I was going down, it would look more like what we have on the screen here, like this. It was just not possible for me to, have these downwards again, blowing my account. Just not possible, because I'm obeying this rule. And everybody here needs to obey it. If you're adventurous, you can go to 2%. Beyond 2%, no more. Now, let me even throw more light. The larger your account size, the smaller the percentage risk you get in. If your account is $100, there's little or nothing there. So you can't. So if someone is using 10% to trade per trade, you know that it's just $100. If it is up to $1,000, please use 2% and nothing more. You can do proper risk management with $1,000. You can't do it with $100. It's too small for proper risk management. What I mean is this: if you're trying to calculate what 1% might look like, your lot size might be looking like 0.005. 0.005 is smaller than a lot size, or rather what we call a micro lot. It will not be executed. The minimum we can execute is 0.01. So 0.01 basically would mean for $100 might look like 15% of the account. So that's why $100 is not the right size you should get into the market with. At least you don't go below $500, so you can properly obey this rule. Okay. Now, if your capital rises all the way to $10,000, please stick to 1 to 2%. Don't go beyond 2. If your capital is around $50,000, what are you doing trading above 1%? Once someone's capital is around $100,000, you see the people trading around 0.5%, half of a percent. Your capital is equivalent to $500,000 or $1 million. People are trading 0.25%, 0.25 of a percent. You see, at that stage, it's no longer about, it's no longer about ramping, to make another 1 million. It's about capital preservation, And mind you, at that stage, your leverage will also reduce. You'll probably be having leverage of 1:100. Okay, but it still doesn't. You can still place 1%, 2% per trade, but please reduce your risk size. Because see, if you make 5% at the end of the month, trading $1 million, 5% of $1 million is that's $50,000. That's really sizable. It's nothing compared to 5% of $1,000, which is $5. You see. So going forward, $5 million, you're talking of much less, and all of that. So let's leave that. Let's move to the next point. Okay. Now, the next point will be avoiding the emotional trap of revenge trading. Avoiding the emotional trap of revenge trading. Now, this one, I can tell you, has caught everybody that has been trading. Now, the only way you're going to, surmount this would be for you to have what we call a trading plan. Do you get it? A trading plan. Now, I'll give you an example or 2 examples of what I mean by revenge trading. Now, someone gets into the markets and then he starts trading. Okay, first trade, his capital is, okay, let me annotate. I feel more people tend to understand when we write. So his capital is, say, $5,000, right? Okay, let's use something less dramatic so some people don't get shocked. So $1,000, right? And he decides that his first trade is going to be 0.05, right? Yeah. He doesn't know what percentage it is out of his capital. He places his trade and then he makes a loss. Now, because his trading strategy would have these results, his trading strategy will mean that will give him a result such that out of 5 trades, okay, out of 5 trades, he's going to make 1 winning trade and 4 losing trades. Okay, and now in this sequence, he's meant to make 4 losing trades, and he doesn't know, but that's the performance of his trading style. Now, the second trade, instead of adjusting his risk accordingly, is like, when I lost the 0.05. Let me increase the lot size so that if the market moves a little bit in my favor, I can cover it quickly and then make some money. And then he decides to use 0.1 lots, and he makes a loss again. And he's like, Kai, let me increase my lot size again. And he now decides to do what? Increase it to 0.5. He makes a loss. The next time he gets in with 1.5. And he makes a loss. At this stage, his equity maybe looks like $300. And he's like, what is going on? Someone is monitoring me. And he gets demoralized and doesn't take the 5th trade. The 5th trade goes positive. Now, what this guy did was what we call revenge trading. And I don't want any of us to do that. So I want us to be systematic traders, as per people that get into the market, like a machine gets into the market, not emotional, but following a trading plan, executing exactly according to the plan. I tell people, if you don't have a plan, or rather if you have a plan, and if you're trading and the market is doing stuff that is not according to your plan, please just sit down on your hands. For those that get into the markets, and because it's moving up and down, they feel they must place a trade, you are going to be you won't be successful trading. That's the truth. You have to, 90% of all the times, literally sit down on your hands and wait for the markets to give you a trade. Okay, let's go on. There's a lot I want to say, but I feel that I might be saying it too early. Let's go to the next one. Now, I'll give you another example of revenge trading. Now, it's just like this. Someone decides to get into the market using 5% of his account to trade. He's not paying attention. He's going into the market with 5% per trade. And then this is what plays out. He has $5,000, right? Now, 5% of $5,000 is $250. Now, if you check, if he loses 20 times, he has reduced $5,000 to $0. Now, that is the effect of using 5% and not what we call it now, and doing what we call revenge trading. But let me show you someone else. So this is what happens to his account. Boom, straight down. This is what I used to do those days. Straight down in less than 20 trades. But someone else that still was not paying attention to the 3rd point, but was obeying the 2nd point. This is what he's doing. $5,000, but after 20 trades, the equity is down to 1,792. You see, he's losing 5%, per trade. Now let me ask, can someone tell me what the difference between this trader 1 here, and trader 2 is? What is the difference between this guy and this guy? Who can tell me? I want someone to tell me. What's the difference? They're both using 5% of their account to trade. But why does this guy have 1,792 and then this guy have 0? Can someone tell me? Feel free to enable your mic and speak. Or you can chat up if you feel you're comfortable with that.
Risk
good.
management.
Risk management. How do you mean?
That's sticking to the 1% or thereabout that you said. And then all the losses, you still have more of your capital preserved.
Beautiful, beautiful. I like that answer. It shows that we're listening and we're following. So you see, this guy or this lady here, okay, is paying attention to what we said on point 1. Always using 1%, or rather, sorry, not 1%, or rather, using, so let me just put in my own words. So he has $5,000. The next trade, the person assumes that what I'm using is not $5,000 like this person. So with this person, let's say the $5,000, the first trade was 1 lot. He decides the next trade, you know what, I can't go lower than 1 lot. That it'll be easier for me to recover. I can't be using 0.9. Next losing trade, still 1 lot. And that's still revenge trading. But this person recognizes that my equity has dropped. I would use 1% of the new balance. I will use in this case, 5% of the new balance, 5% of the new balance, 5% of, and now what that creates is a parabola. You see, if I look at your trading results and I see these, I do not see these, I can tell if you are going to be successful or not. This is what you need to see in a successful trader's, portfolio. He has to flat. So this is what we call flatlining your losses. There has to be. We need to see a parabola. It helps us know that this person is reducing the risk each time the equity drops. So okay, the next one I'll bring it up on the next one. So this is what we're looking for. So let me tell you, with $1,792 remaining, you virtually have around about 35% of the equity remaining. You're still in business. You can still recover, unlike this chap. So this is another rule. That's why I keep telling you, if you're using 1% to trade, you can stretch out. It won't be 100 trades for you to close that account down. It will look like 180 trades because of this style of trading. Okay, let's go to the next point. Now, this is always making your rewards way more than your risk. And so this is a very, very important point. Your rewards, what you target in the market, should always outweigh the risk you are presented with each time you get into the market. Should always. And I think the best way to explain this, I have more like an example I'm going to bring up for you to understand. Okay. So imagine this. Let me give you an example of a story. I'll tell you a story of a monkey and a heap of bananas. Now, I'm going to liken this example or this story to what goes on in the financial markets. Now, imagine that this monkey rather is the financial system, is the financial system. And the bananas it guards is money that we're all looking for. Now, if you come there, because it's a big monkey, you come there to collect one banana, what happens? It will attack you and most likely chop off one finger from your hand. So there's no way to just go there and just collect bananas. It's just the same way you want to go and collect money. The money is there. It's there. It's in buildings, in vaults. You can't just walk into Standard Chartered and say, okay, I'll just go and then I'll open the vault and collect money. As you're doing that, they will gun you down. It's the same thing. So, but how do you get the money from these banks or these institutions? How do you get the banana from this monkey? It's very straightforward. What you need to do is this. You need to come to the monkey with what it understands. And what it understands is banana. So you come with bananas. You come with a bunch of bananas. The same way you come to the financial sector with what they understand. It's not begging. You can sit down in front of a bank and beg from today to the next 10, 100 years. You will not get the money in the vault. They won't give it to you. It doesn't respond to cries. What it responds to is money. You come to the financial sector with money. Now, the next thing you do is you don't just, carry your bunch of bananas and then throw it in. That's what foolish traders do. They place one trade. That's called gambling. And so they bet the whole house on just one transaction. So either they win or they lose. That's terrible. What you want to do is out of the bunch, you want to break out one banana and get the attention of the monkey. So the monkey sees that one banana. Because it's a monkey, it's always greedy. The ones he has is not enough. He wants the one you're showing it. So you wave it around, and guess what you do next? You fling the banana far. So what does the monkey do? It leaves the one is dealing with, or rather the one is guarding, and it goes after that one banana. And now while it's at it, what you want to do is you run in and you break off maybe 3 bananas, 4 bananas, as the case may be, and you rush back, put it in your basket. And now the monkey comes back and is with that one banana, and it's so happy that it has your banana, it's jumping around, and after a while, it simply gets bored. It has gotten the banana and he flings it into another set of heaps. But for that transaction, for one banana you risked, you got back 4 bananas. So your risk reward ratio was 1:3. Are you seeing that? It's the same thing in the financial markets. When you want to transact, you come with 1% of your account. That is what you're putting on the line. But what you're targeting is 3%. Are you seeing it? You're not going for one banana. You don't throw one banana, you're going for half banana. Doesn't make any sense. You throw out one banana, you're going for multiples of it. From 1, 2, 3, 4 to 12, whatever, as far as whatever you can get from the markets. So it's the same principle. And I want to show you how that works. Now, if you notice, I'm doing a lot of calculation here just for you to understand the numbers, because you need to understand how the numbers work. Every business has formulas to work it. Name it. Construction has formulas, for what concrete mix, what formulas work, what formulas are effective or economic in you being successful. Poultry, for instance, has mixed formulas. What you need to mix for laying beds in this proportion, the fish meal, the bone meal, the maize, what proportion of it, this one, salt, what proportion. You need to know the right mixes. If you decide, okay, it's not chicken, you can carry it, to give it gari. They will eat your gari, no problem. But the next day, you will not see egg again. That's the end of your production. So you want to follow the right mix. There's always a formula. And then when it comes to production in all these sectors, there are certain things that make them succeed. Sometimes it would be, for that business to succeed, it might not just be you buying let's use poultry, for instance, buying the feed and then feeding them and they produce eggs. It might simply be cost advantage, you producing maize to bring down your overheads, make it lower. It could simply be technology advantage, where you have something unique in your production process that helps you produce more or cheaper. You have to have something unique, so it's the same thing. There's a math to making a success of your financial transactions. And this is it. Now, this is the first example we brought in. And in this one, we talked about learning to determine what the risk was. And we said the risk was 1%, and then manage it. So we're managing based on what the new equity was on each stage. 1% of the new equity, 1% of the new equity, never ever breaking those rules. Now, after 15 losing trades, we had around 87% of the equity remaining. We're very much still in business. And now this particular chap now decides, or rather learns this new rule, always learning to make sure that your rewards outweigh your risk, okay? And then in the process, he now decides to go into the markets with 1%, as he's always been doing, but now targeting a reward of 3%. And now, so for the first trade, he's successful. And 3% of 1,720 is 1,000, so that's around $50-something, right? So it gives you $1,771. Now his equity is growing. Now, after the first, second, third, fourth, on the fifth trade, he has very much recovered his equity or his balance or capital. He has very much recovered the capital. Are you seeing that? On the sixth trade, he is profitable. Now, some will be wondering, how is it possible to lose 15 times and simply have 5 winning trades, recover it all? That is the math of trading. You need to understand it. If you understand it, this is what plays out. Your chart looks like this. You can well as much take as many beatings in the market. But with a couple of productive returns, you are back to where you started and even profitable. You see, this is the formula for success when it comes to trading in the financial markets. This is what it is. This is the math that makes things successful. You can have variants of this, but they would all obey these rules. Very much obey it. Reducing your risk per trade, flatlining your losses, so it's somewhat of a parabola. Third is you want to make sure that your rewards always outweigh your risk, so that I can afford to lose 5 times and in 1 or 2 trades cover all my losses. So effectively, let me show you what's playing out. When it comes to trading, let me annotate. So I hope I'm understanding what I'm saying. I hope you guys are getting it right. Are you getting what I'm saying? Are you following?
Yes.
Okay, beautiful, beautiful. Okay, so I'm going to give you, I'll show you how this plays out. Now let's assume that what you started out with was $1,000, right? And then this is 1 month. So 1 month, right? Okay, now what happens is this: you're going to, let's say your trading style assumes that you're going to make around 50 trades for that 1 month. That's your trading style. You're a day trader or you're a scalper. So you make that many trades in it in a one month period. Now you might start off with having, let's say you had a series of 5 trades. So those 5 trades, losing trades, you're losing some money, right? And some more losses, and then you make some profits, you're up, some losses, some profits, up, some losses, some profits, profit, losses, profits, losses. Now, at the end of the 1 month, this thing you see here, okay, so this you see here is this. I seen it. But you're going to have series of this to eventually give you what we call a trading result for the period. And what we're after is this. When you look at the end of the trading month, you have a return of investment from $1,000 to $1,500. You have a return of $500. But in between, you made a lot of losses. Lots of losses. I see lots of losses. So I keep telling people, don't let the losses phase you. Because if you're obeying the principle, a couple of profits would cover up for the losses. So in total, you might look at this. You might have nothing more than 15 profits, and then the rest 35 as losing trades. And yet you're making 50% capital, 50% return on your capital. I seen it. So even if you lose, you shouldn't be afraid because it's just 1%. You lose again, it shouldn't stop you. And there's a video I was watching so many years back, and the guy was talking about trading. Trading should not be a finite game. What I mean finite, you get in, so you make a loss, and the loss could either determine your ability to get back into the market. So what it simply means is that you're getting into the market with so high a risk percentage, but it should be more like an infinite game. Those games like Minecraft, they're these games that you can play forever. So you get into the market, okay, it doesn't go your way, you look for another opportunity, get in again, it doesn't go your way, you look for another opportunity, get in, it goes your way, you make money, look for another one, it doesn't go your way. Because your losses are so small, you can always make a re-entry. And that's what it should be. But for the mere fact that you're compounding, when we talk about flatlining your losses, so your losses, assuming that this is what we have as a graph layout. Okay, let me clear the screen. Okay, let's use it. So if you're flatlining your losses, you will notice that your losing chart looks like this, right? But if you're following the same principle, your winning chart is not like this. How do I believe it now? No, I don't want to be that way. It's not like this. Rather, it is like this. It is exponential. It's also parabolic upwards. And so that's why it's possible to bypass. So you start with $1,000. It's possible to bypass someone that is trading arithmetically. So see, the person is going like this, but because you're trading geometrically, your account is shooting up. This is all math. And if you understand it, it works for you. So we don't need to complicate things. I'll just make things simple and then we go on. Okay. Now, I'll go to the next point. So if you've noticed, when I'm talking with you guys, you know that it's a lot of knowledge that has been gleaned from trading, and these are principles that really work. Okay, now the next thing is understanding the statistics. And so this is what brings everything together. Most people don't even, so they never knew that all these things can come into trading. They are very much there. And it's important to understand before you get in. Okay, so I'll give you an example. So imagine someone that has a success rate. So each time he gets into the market, out of 10 trades, so the success rate is 30%, the failure rate is 70%. Now, according to our school books, if this was your result, the result you showed your father or your mother, preferably father, at the end of your 1 term, after they paid your school fees, you know what follows now? Koboko. A long cane will follow you as in all over your back and your body. So you came last in the class, 30% out, that's your return, your result at the end of the term or the session. But when it comes to trading, you can still be successful. Just winning 3 out of 10 trades or getting a success rate of 30% because you're understanding the math now. So for you, so what this means is that out of 10 trades, only 3 were successful and 7 were losing trades. Now, why you're still successful is because of this. Each time you lose, you only lose 1, but when you target to win, you go after 3. So like you risk 1%, you're targeting 3%. So in pips, let's look at it as, so each time you lose, let's say your stop loss is 30 pips, right? You lose 30 pips. Now, because your failure rate is such that you're losing 7 out of 10 trades, so it will be 7 times 30, right? That gives you 210 pips lost. Okay. Now, but each time you win 3. That's 3 times 30, right? That's 90 pips. You win 90 pips, right? But because you're winning only 3 times, right? So 3 times. So that would be 3 times 30 times 90, right? That gives you 270 pips. Now compare 270 to 210. The person is mildly profitable. Are you seeing that? That's the math. And so this is what calms you down when you're trading, because you know that your risk reward is in your favor. It's what calms you down and keeps you going. So you see, I want you to see trading as a business. It's not a gamble. This is a business that you can subsist from. You can make returns not just for a year, but for a lifetime trading. I tell you, for last year, the financial sector raised more billionaires globally. So over 27% more, followed by manufacturing, followed by IT. IT accounted for 17%. You're in the right industry if you're looking for unlimited returns, but you just need to understand how to manage your risks. Okay, so going in, now let me take you further. Look at this next example. Okay. Now, you have a client that has a success rate 70%. Is a bad guy. This just brought to memory one of an example. Someone showed me her winning trades. Okay, second. So someone showed me. So some people were wondering who is talking. I decided to enable my camera so you see my face. One of those classes I was shown. So she came to the class and then she showed me that I've been trading and look at my results and all of that. And then it was a demo account nonetheless. And she was flicking. She had 5 good pages, 5 pages of successful trades. So you just see $1, 0.7 cents, $3. The highest I saw was like 4 point something dollars, $2, $1, 0.6 cents, 5 pages of it. On the 5th page, I saw something in between, just one trade, and it was in red, minus $700 and something. And I laughed. Such a person cannot be successful. That's what happens when you don't use stop losses. Your upside is limited, but your downside is unlimited. So look at this. Someone decides, okay, you know what? I want to place a trade, right? And then out of 10 trades, 7 of them are winning trades, but 3 of them are losing trades. Now, if this was a report card you took home, your parents would be so happy with you. She made an A1, But this is pure failure. Because in the financial markets, we need to understand what we are risking per trade and what we are taking as a reward per trade. Now, look at this ratio. If we flip these, around, you find out that because she's losing 7 times out of 10 trades, and each time, okay, so the assumption is this: wow, I have 90 pips as my stop loss, and then 30 pips as a take profit. Now, if I open my chart, you find out that it looks straightforward. Before the markets can hit you, or rather can go against you 90 pips, most likely to swing in your favor and give you 30 pips. It is very logical. It makes sense to the, anybody thinking. And so you find out a lot of people use those kind of strategies. The stop loss is 100 pips. It's so wide, that's the assumption. The market is so far, away. And then our take profit is just 20 pips. So they keep on making profits. They show you their results. They look like bad guys, but they're flouting this rule. What this would entail, for you to be successful trading like this, you would need to make, so out of 10 trades, you're going to have to win 8. And that will just be break even. So for you to have some little profits, you have to win 9 out of 10 trades. And that is crazy. It's crazy. It's almost impossible, And so you see such people making losses, despite the fact that they have a lot of winning trades. They keep making losses. This is what I'm trying to point out for you. You need to, I'll underscore the same points, the points I made earlier. You need to, number one, determine what your risk is. And I'll tell you, everyone here, not more than 1%. A bit more adventurous, 2% per trade. You need to manage those trades by reducing the risk. What I mean is this: know what your new equity is, and use this percentage of the new equity. And then you need to always make sure that your rewards outweigh your risk. So if you get into a trade and your stop loss is 50 pips, no way on earth should you be looking for a take profit that is 30 pips. Do not do that. What you're doing is that you're sending yourself to this statistic. You must pursue 50 pips above. If your stop loss is 30 pips, never go for 20 pips return. Always go for 30, 40, 50, 60, 100. I get it. Don't make this mistake. If you get it, or if you look at a trade and the stop loss is 100 pips and the potential reward is 50 pips, please walk away from the trade. Yeah. And then you notice the market goes in your favor. You make the 50 pips happen. Do not go for such setups. If you go for such setups, you put yourself in this statistic. It makes it tougher for you to succeed. Always look out for scenarios where, okay, if the stop loss is going to be 70 pips, and that's wide, okay, your upside potential being 90 pips or being 160 pips, you saw it, it's there. That is a trade worth going for. And so if you get into that trade, please, even if you get to 50 pips, don't take the profit. Even if it goes down and goes against you to maybe minus 20 pips and then goes back to 50 pips, do not take the profit. The worst thing you could ever do is have a break even, as well, leave the market without a loss. But don't take that profit. If you're going to take the profit, let the market break to the upside above 70 pips or in its multiples. That is the scenario you need to employ to be successful. You see, it's not in the frequency of trades you make on a day-to-day basis that will determine whether you're successful or not. I can place just 5 trades and I can make a return far better than your own, but than yourself, than someone else that's placing 100 trades. So what you need to do is look for the right setups, make sure the risk is low, make sure the reward, there's potential reward in it. So I maybe at the end of the whole thing, I'll share with you my performances. For me, what I target okay, I target anything around 200% yearly. Okay, but in truth, what I target is 500%. That's what I do. And so I've hit my target severally. I've hit my target severally. Last year I did over 300%. The previous year I did over 500%. Yeah. But I don't take the profit. I allow it to compound. I have results. You check my FX book. I have 1 or 2 results I put on my FX book. A whole 1 year of performance. And you see, I obey the very same rules. So if I'm a fluke or my results are a fluke, I will have consistent results for 1 whole year. 1 year is not 1 month. People can do 1 month and give you a result. I have years of results, years of successful results. I have a trading style that I've been trading for 5 good years. Results. I have another one, but that one doesn't give me that much return. It could possibly give 50 to 70% yearly. It's very low risk. But this particular one allows me to compound. So I can do 300, I can do 500% yearly, but I must compound. And so I'm teaching you the things that makes it possible. And if you don't pay attention to it, you go on, you know what you do, you end up rediscovering the wheel. You spend 1 whole year, 2 years, 3 years to find out that the wheel is secular. But we're teaching you that the wheel is secular. Why not just understand that principle and build on it? Let's go to the next one. Okay, you know, because of time, I don't think we can go so far, but okay, you know what? What I would do is this. We're going to break this class into two sessions. Our webinar shouldn't be more than 1 hour. We've gone 1 hour, 20 minutes. So in total, we're going to go in 1 hour, 30 minutes. I will continue with this. We're going to have a part 2 of this. You know, I'll go with this. What I'll do is I'll take you through this part, understanding your place in the global financial markets, and I'll show you how to build. I'll take you through other slides and all of that. And then the next thing we'll do, maybe on the second part of this webinar, would be I will show you how to build a trading plan. So we'll randomly pick up indicators, and we'll use these same principles and apply them to the indicator, and we will look for a successful trading plan from it. Or just look for a trading plan that seems to work around it. And we'll eventually, once we do that, because so the next seminar is I'm going to complete this part, and then I'm going to take you through the charts and show you how to apply these rules to your charts. And then we're going to have another one, and Obi will be taking this one, and then we'll show you how to possibly build an EA with, let's say, this strategy that we'll be building, or rather we'll be learning. Okay, we'll show you how to build an EA with it. So there's a whole lot of content that is of value. And I can bet you one thing. See, I will say it from today to tomorrow. Go for all the webinars you want to go for on brokerages, on different platforms organized by different brokers. You will hardly see, you might not even see any broker or country manager or people that manage the broker that have results that are positive. Most of them don't even trade. They will not have results to show you. And so as a result, they cannot show you systems or tools that can help you succeed. I'm a trader, that's what I've been. I've always been a trader. And so that has been, I have the results to prove it. And so what you learn are things that actually do work, and not stories, not hodgepodge, you know, stories. You know, you're going to learn things that actually do work, and things that can turn around your trading, that can help you make profits and all of that. Okay, so I think the last thing I will need to do is I'll need to take you through. So I'll close the slide, and then we'll go to the internet. I'll just show you 1 or 2 things just to reference what I'm saying and help you understand how it can you can play out this same trading plan on yourself by yourself. Okay, so 1 second, please. Okay, I'm going to. I want to navigate away from there. Just 1 second. Okay, so let's open to my FX book. So I just want to walk you through like just an example of my own performance, so you have a view and see how, so you can know what is realistic to expect in the markets. It's not magic. There are things that if it happens to you, is normal. It shouldn't discourage you from trading. It's part of it. What we're looking out for is the result at the long term, not the short term. Okay, I'm wondering why it's taking a while to open. It's a bit slow, but it will open. Okay, good. Okay, so okay, this shows you my own performance. So my username is just Okafor IK. That's so I want it to load. I think it's slow. It's really, really slow. Okay, while it's doing that, I'll just load another page by the side. Yes, it's not even highlighting. Okay. I'll load that by the side. I just want this page. I want this page to load first. So let's give it a little while. Now, if you have any questions, feel free. You can type it. You can ask. Just feel free. You can do it at this stage. Okay, good. This is the more important part. Now, if you look here, this more of shows. Okay, so I have this is more of a trading style. So if you notice, this is August 4, right? 2020, right? And all the way to September, October, November, December, January. So all the way down to, so this ended in June 21st, okay? But around August, the other year, it was way over 500%. So at this stage, at May, it was 422%. You can see that 0.78. Now, that's just to underscore a point. There's another one here that I opened here. So that's here. Now, the reason I opened this one, I wanted to just show you something, just so you understand how it works. I've actually grown an account. I've grown an account last year that I allowed to compound for almost a year and a half, almost 800%. 800%. That's crazy. When I used to do Fire for Fire, that was, I remember 2008, I've done one. It was way over 2,000%. But I don't recommend that kind of thing. You know, it was $5,000. We pushed it to almost $500,000. Well, we crashed it like 5,000 like 3 times. It was the 3rd time that I all the way up to $500,000. So I won't recommend that. That was just high risk trading. I was done within 2 months. Don't do that. It was EAs we were using. Okay. So this is what I'm after. Now, so 2020. Okay, so the result from 2020. Now watch. The first month minus 4.9%. Now, some might say, after a whole month, you make a loss. It is part of trading, you will make losses. Some months will not be productive. Now, but the next month, if you keep going with your trading plan, if your trading plan is okay, you can still hope to recover. So that month I had 17.79%. Someone will be saying, can't it be 50%? 17% is small, but it is a lot of something. Your treasury bills does not give you up to 3-4%. That's 4% in a year. I think gives you around 3-point-something% in a year. Is next to nothing. This is 17% at the end of the month, not at the end of the year. Now, the upper months, this was a good month for the trading strategy. The markets cooperated so much, so we made about 67%. The next month, 11.5%, not much, 27%. But you see, if you add these results, you won't have so much, But if you allow it to compound, that's where it does the wonders. So 2021, that's 44%, and then the next one we now did -6. You see, there are months that are not favorable. Then 13.9, 17, 9.8. So some might say these returns are too small. When you allow it to compound, even with this -7.31, you find out that it does wonders. So this is what the growth will look like, and all. So, well, okay. So basically, that's what I'm trying to show you guys, the kind of results you can end up getting. If you get 13, 15% monthly, you're doing very well. If you get 10, if you get 9, allow it to compound. At the end of the period, you will see the final results and you'll be happy. Some months will give you really favorable results, but don't pursue 44% at the end of the month. You don't need that. If you pursue this every month and you say, but I must have it by force, you're going to crash the account. So you need to stick with the trading plan and stick with the principles behind the trading plan, and I bet you'll be successful. Okay, so I think I've come to the end of what I was sharing, and I want to ask if you have any questions. This is the time to ask. Any questions? Any questions? Feel free. If you type it out, you can ask it. Let's discuss. So before the questions, let me ask, did we learn anything? Let me know if I was talking to myself or to actual human beings. Did we learn anything from today's webinar?
Of course. Thank you so much. But from
Thank
my
you.
notes, I think we covered only 7 points out of the 12.
You know, yeah. So, like, if I teach you everything, what will I teach tomorrow now? So, let me teach small then tomorrow. Let's remain small for tomorrow. You know, we'll get the knowledge. We'll have another webinar. Today is Wednesday. So we should have another webinar this week, worst case, early next week on this. We'll continue on this. Okay. Someone just joined now and missed lots. Don't worry, there will be a repeat of this webinar. Don't worry about it. There will be a repeat of it so you can participate. Okay. Does anybody have any inputs or any contribution or any question?
Let me ask one question.
Okay, go ahead.
Maybe we just need a clarification between a swing trader, a position trader, and which third one now? Where you want to do day trading, you know, and also depending on the size of account, like you explained earlier, those that can take only 1 or 2 trades will not need to copy bigger accounts that can do 4 or 6, even if they are day trading. Those are just the 2 things I want you to quickly please explain. Thank you.
Okay, for the first question, now there are different types of traders. You find out that when you start, you might most likely find yourself around scalping. Okay, but along the line, you might end up around becoming a positional trader. So let me describe. A positional trader is the person that gets into the markets, okay, and they look to hold positions for like 3 months all the way to a year plus. So each position they are in spans more than 3 months. So they might buy euro dollar because they forecast something in the future, or they might decide to sell oil because they can see, okay, they forecast that maybe the Ukrainian war is going to end very, very soon. So they want to be amongst those that get in on time because they see stability come very soon. So they might decide to sell oil on the midterm or the long-term basis. But these guys end up placing maybe 1, 2 trades in 1 month or in a year. So for an instrument. Now we have what we call swing traders. Swing traders are, you know, these guys get into the markets, they're looking for swings in the market. They're looking for periods when the markets are rallying up. So they might get in at the bottom to rally all the way up, okay? And then the market inverts and is going downwards. They're looking for an opportunity to sell and follow the markets downwards. They're looking for an opportunity to buy and follow. For each length of swings, that's upside, downside, you know, it might span maybe 3 days to like 2 weeks. So most likely swings sometimes are longer than that, but 3 days to 2 weeks. So swing traders get into the markets for, so you might find them in positions that might last from 3 days to 2 weeks. In a month, some of them might not have more than 5 to 12 positions in total, maybe on an instrument that they trade. They might not have more than 5 to 12 positions. So they hold their positions overnight, sometimes over the week. And that's how I trade. I am a swing trader. That's my trading style. Another set of traders you would have are called day traders. Their trading style is different because they believe in closing the trade at the end of the day. So what they're looking for are intraday movements. So within the day, they're looking for the low of the day. They're looking for the high of the day. So they're looking for where to buy and make profits within the day, looking for opportunities to sell and make profits on the downside. They are intraday traders. So they might get into 1, 2 trades on an instrument in a day, or, you know, maximum 5, you know, trying to take advantage of the swings within the day or the volatility in the day. But you will hardly see them. You might not even see them hold trades overnight. They don't do it. They close it at the end of the day. Okay, and then we now have scalpers. So one way you know a scalper, when you look at them, when you look at their eyes are always twitching. So it's always twitching, and it's always red because they're always they're always watching the markets. Their eyes are always on the markets. They're looking for every tick They're looking for every movement, you know, looking for always all the opportunities. Someone is laughing. Always every opportunity in the market they want to get in. And when they get in, the place they buy, you know, they keep using their eyes. They think, you know, by looking up, you know, that they will make the markets move upwards. You know, I would not recommend you starting out as a scalper. It can be a very frustrating place to be in. You know, it's like imagine trying to catch a squirrel. And you're pursuing the squirrel everywhere. You know, it's not possible. You're going to eat dust. That's what scalping is like for the newbie. But then there's a possibility you can, over time, have a trading style that you can program that helps you scalp. So that basically is. Now, the second question, I can't remember it clearly, but if you can re-ask it, I would love to answer it. Can you ask the question again? The second question, I can't remember it again.
Oh my God, the difference between the traders and then those that want to copy large accounts and do multiple trades on small accounts. You know, I think that goes on the risk management you taught us earlier.
Okay, yeah. So, you know, now that I showed you this, when you're trying to do copy trading, it's always good you look for results. Now, someone shows you a result like mine, you would want to ask, okay, so what's the maximum drawdown risk you've experienced in your trading period? So mine was around 27% maximum drawdown. So you want to know, that's going to tell you the maximum risk you're exposing yourself to a person. And now you can tell the person, you know what, I don't want to risk anything more than 30% of my capital. So at any point in time, we lose or risk 30%, or we get to a 30% drawdown, please stop trading. So you know that's what you're risking, and then you look at the upside, what the guy is able to perform or produce. So when you're copy trading, especially, let's say for instance on our platform, so we have auto trade, you need to see the performance. You look at the performance, you know the drawdown, and then you know how the return on a monthly or daily basis. And based on that, you've armed yourself with some information, and then you can even go further. Like I've taught you about risk reward. Check to see, does this trader use stop loss? If he doesn't use stop losses, please jump and pass. Go to the next trader. Copy the ones that use stop losses and all of that. And you find out that you can have some very good results that will come out from copy trading. I have a lot of guys on copy trading that are doing quite well if you obey these principles. Okay, there are a couple of statements I'll put here. Okay, thank you. Okay, so Joy said, thank you, sir, for the information shared. It's very key and helpful. You're welcome, Joy. What time position is the best time to sell or buy? No, we can't answer that today. We'll do that in the next session. Next session is going to be very interesting. I'll be showing you guys a lot of things about, I will be on the chats. We won't be doing slides, we'll be on the chats. You know, we'll do a little slides, but we'll move into the chats. And I'll be showing you how to build a trading idea that can work. Okay, and then, okay, good afternoon, sir. Okay, how can I get a record of this class? Okay, don't worry, talk to your sales manager. They'll send to you afterwards. How can we get the video? Okay, same thing. How do we know when to place trades? Don't worry. On the next class, so we have a series of classes that we have internally, but there'll be the next class I'll be paying a particular attention to that. Okay. And we'll send the links for that out. Don't worry. It won't be more than a week from now. It will be in between a week. What is the risk ratio of placing multiple trades using 1% risk? Now, I need to sound this one out. If you place 1%, a trade of 1% on GBP JPY, do not, under any circumstance, get into another trade of 1% on GBP JPY. Now, there are different trading styles that might require you to have multiple positions, but then be careful, because if you build on your positions, your total percentage risk to that instrument will not be 1%, it will be 1% plus the number of times you've gotten in 5 times. It is now 5%. So you need to notice that. What I would say is this: if you trade 2 instruments, then 1% each on those instruments, and then please wait for the trades to close out before you trade again. It's the more responsible way of trading. If the market doesn't stop you out, so 2 ways. It's either the market gives you your profit or the market stops you out. Let it choose one. It must either stop you out or give you your profits. Work based on that and you will go far. Okay, so says, thank you, sir, for the lecture. And it's been a pleasure to have or hold this lecture. Okay, let's just go through the next one. Please, sir, what would you suggest for a new trader, swing or day trading or scalping? I would suggest for a new trader that you get into day or swing trading. Leave scalping alone. You can't do positional trading because you don't have a lot of money. If you're trying to do positional trading, you should need like $50K or $100K. Doesn't really make sense, you know. Start with swing or day trading. And then I'm interested in compound trading. I'll show you guys how to do compound trading. That's later on. Okay, guys, we've come to the end of today's webinar. It's been interesting, and then we spent an hour, 40 minutes. I guess we've taken a lot of principles back home with us. Go through your notes. You could also get a link to the recording of today's webinar and replay it. Practice what you've heard, and then look out for the links for the next webinars. We'll build on it, and I'm happy to have you guys. It shows that a lot of us are serious about taking our financial well-being to the next point or next level. See you guys, and I wish you guys a wonderful week ahead. Okay, cheers. I'll be closing the room at this point. Thank you for attending.